Hi there, my name is Buster Tolfrey. I am the Director of Mortgages for United Trust Bank. UTB, for those that don't know, are a specialist lender. We've been active in the second charge market since 2015, and I'm going to take the next 20 minutes or so to talk to you about how you can build your second charge business. Some of the things that I'm going to talk about is typical customer profiles, the types of products that are available, and also how you access those products. I'm going to do this with a bit of a presentation, so hopefully it won't be death by PowerPoint, and I'm doing my best here to operate within the confines of Zoom, so I'm going to be sharing my my screen, which hopefully goes according to plan. So here we go. There we go. I hope everybody can see that. So that's my little avatar, the Mythbuster, which is the role I'm going to be playing today. So as I said, we're going to talk about how to build your second charge mortgage business and also bust some of the myths that I think exist around second charges, which is a really useful product for your toolkit. So what is a second charge? Let's start off really simple, shall we? So a second charge is quite simply a mortgage that is registered at Land Registry on the customer's property behind their first mortgage. Now, seems pretty obvious, but it's not a very well-known product, out there in the public domain. A lot of customers didn't really want a mortgage to start with. They wanted a home, and on the basis they didn't really want their first mortgage, they probably didn't want a second. So what I'm going to do today is just run through some of the typical customer profiles that you will find, or where this product set might be applicable. So starting off with, when are they used? So typically there's one of 5 reasons that customers will enter the second charge market. Big one though is they've got a mortgage simply too good to touch. So their first charge might be on a low interest rate tracker. It might be interest only. It might have ERCs attached to it, but basically they want to leave that product alone. And they're looking to raise some funds, typically for some sort of other consumer purpose, which I'll come on to in a minute. They might have had a change of circumstance, which makes a mortgage or a further advance more difficult. So recently self-employed, or a little bit of adverse credit recently, something of that kind of ilk, a quirk. They typically want to buy more than £25,000, which obviously isn't available with a personal loan. The average second charge is in the £45,000 category. So it gives you an idea of kind of the average loan size. And they may want to borrow that money over a different term to their mortgage. So mortgage 25 years, typical second charge will be over probably 12 to 15 years. And they're also looking for a rate that may be cheaper than a bridge, a credit card or multiple credit cards, or an unsecured personal loan. We're also going to cover how do I access lenders, which includes through the wonderful people at Brightstar, of course, and a typical customer profile. So moving on to our next page, just a summary of some of the categories going to go through today. So we're going to cover a bit of market, a bit of product, a bit of usage, and a bit of customer myth busting as well. So starting off with some of the market myths, a lot of people would say this is a tiny and flat market, and let's be honest, it's kind of peaked at 115 million just pre-COVID, down from the height back in 2008 of 400 million. So it is a relatively small market, but it is also growing. There's a lot of kind of bad press that second charges get associated with that pre-2008 market. So things like self-cert, high adverse credit, 125% lending, populated by small backstreet lenders, that sort of thing. And the reality is that just isn't the case anymore. The largest lenders in the market mainly are banks, so include the likes of UTB, Pepper Money, you've got Shawbrook Bank, you've got One Savings Bank. So this isn't a market that's got small lenders in it by any means. It's a market that's populated by large PRA regulated banks, and obviously all of the regulation that goes along with that. Now, second charge is regulated in exactly the same way as a first charge. So under MCOB, came into that regulation back in 2016 under MCD, and has seen a huge amount of change post credit crunch. Some of the things which I'm going to draw out for you now. Now, to kind of bring to life what I mentioned about the size of the market, I just wanted to give you this graph here, which shows that back in 2007, the market peaked at around about 450 million a month. And as you can see, large drop during the credit crunch years and has been recovering over the last two or 3 years, with clearly a drop as a result of COVID, although that is now nearly normalized. Now, I would argue the market that exists today did exist back in 2007. So mainly prime, full mortgage regulation. That market existed in the same way as today's market did. But what has dropped away is a lot of that other more spurious lending, the likes of the higher LTVs or the heavier subprime. And if you make the, I think you can draw parallels between the second charge market and the first charge market in that respect. First charges no longer lend to 125%, and you can no longer go and get any plans without proving your income. And that same transition has happened in the second charge market. Really a product that is suitable for a wide range of people. If you're looking at a remortgage, you're looking at a further advance, you really should be considering a second charge in that same conversation. Won't be suitable for every customer, but neither will a remortgage, especially if they've got ERCs to pay at this point in time. So big point here is lessons have been learned. That market that existed back in 2007, 2008 simply doesn't exist today. It's a much more prime focused product range, populated by PRA regulated banks. Certainly most of the applications that we receive, the first charge is with a Nationwide, it's with a Lloyds, a Halifax, a prime lender, but they're coming to us as a second charge lender because they want to leave that first charge product alone. So in terms of products, some of the myths that we regularly hear spoken about in terms of second charge products, people think you can only get a variable rate, and that's just not the case anymore. There's a wide range of products out there on a second charge basis. Yes, variable rates are available, just as they are in the first charge market, but there is also a wide range of other kind of incentive-based rates, just like you see in firsts. So anything from a 2 or 3 or 5 year fix, there are 10-year fixes available with some lenders, a range of different ERC options. None of those fixed rates from any lender in the market contain overhangs in terms of the ERC tail. There are even a range of products available that are fixed with no ERCs. Now, you'll pay a slight margin, or the customer will pay a slight margin for that, but it won't be, a significant level of bips, especially given interest rates are at an all-time low at the moment. So, from a UTB perspective, just over half of the lending that we do is on a 5-year fix with no ERC. So customers are free to refinance away or redeem their loan or pay lump sums off indeed at their whim. And what you tend to find happen with a second charge is the customer will take it out for whatever the purpose was, whatever the consumer need they had at that point in time. And then they will typically redeem it, usually within about 5 years. And that typically happens because they are moving up the property ladder, or they're remortgaging when they've come to the end of their fixed rate on their first. Seconds are expensive. Again, that's just not the case. So yes, I would have agreed with that statement back in the early 2000s, but no more. Interest rates in the second charge market start from as low as 2.89. Yes, that would be a lower LTV product, but typically up to 70-75% rates are available from 3.5, 3.6 to about 4%. Now, if customers have got a credit blip more than 2 or 3 years ago, typically second charge lenders will ignore that because what they're looking for is recent quality of conduct. However, if they have got adverse within the last 2 or 3 years, there are lenders available. You may find that the LTV will be a little restricted, so it might be capped at, say, 75-80% LTV. And there will be a little bit of an extra margin on that rate. Good example would be there's products available at the moment for customers that have had a mortgage arrear in the last 12 months, up to 85%, and they're available in the 5s and low 6s. So yes, a margin, but remember they can leave their first charge alone, take the second charge for whatever purpose it is that they're looking for, and then refinance that whole sum away, once that adverse has passed away and they've come to the end of their first charge fix. And the third myth that I'm going to hopefully bust today is that it's a slow and painful journey. Again, this is not true. Second charge market has made a massive amount of investment in technology, and in many ways are further ahead than the first charge market in terms of ease of access and speed of journey. And that's part of the reason for that is a lot of the time second charge lenders are competing with a unsecured loan provider. So yes, it's regulated mortgage advice, but if the customer was looking for say 25 or 30,000 pounds worth of money, they might have applied for an unsecured loan, and so their expectation is that they will be getting that money quickly. And second charge lenders have kind of taken that ethos and tried to apply that into their journey, automating a lot of the what were perceived as painful previous pinch points. So talking about products, as I mentioned, lots of different rates and types of interest rates available. We have got trackers, yes. Interest-only products are available, typically with a lower LTV, maybe in the 60 to 70% range. Variable rates, discounted, fixed, capital repayment, a whole host of products available. Different lenders have got a different mix. So, for example, Optimum Credit offer discounted and fixed rates. At UTB, we just have fixed rates or tracker products, similar at Shawbrook Bank. But there are multiple products available in the market to cater for any one of a number of different customer needs. In terms of rates, I mentioned already, variable rates typically start at 3.6 with no ERC on that. Fixed rates at the moment are starting in the 3.8 for 2-year, rising up to the 4s. There are other products available through other lenders, of course. I just wanted to give an indicative example of kind of where the current UTB rates are set at. And then in terms of kind of the other product myth around speed, and I want to take a little bit of time to just talk about this. So second charge lenders take a lot of comfort in the fact that there is a first charge in place. Now, most fast charge lenders will have got a full valuation when the property was bought, especially on a purchase application. And therefore, second charge lenders are happier to accept AVMs in a lot of scenarios. At UTB, we take AVMs up to 75% LTV, but other lenders in the market do take them up to 85%. Now, the benefit of an AVM, and typically the provider is Hometrack here, the largest name in the game for automated valuations. The benefit of an AVM is obviously speed. We don't need to wait for a valuer to go and value the property. We can simply, via an API integration, which most lenders have, to Hometrack, get back the value at the point of sale. And that piece there is actually really important because typically a second charge borrower will be looking for funds relatively quickly. It may be they may be looking for debt consolidation, they may be looking for home improvements, they may be looking for, it could be a tax book, it could be school fees, it could be a holiday, it could be one of a number of things, but typically speed is a key driver. Using those AVMs, we can then pass that into a point of sale decision in principle. Nearly every lender in the second charge market offers a DIP, and typically that will pull in an AVM and credit search data to give a binding decision on day one. Now, naturally, as you'd expect, the output of those DIPs goes from anything from kind of approve, refer, decline through, to quite more specific actual underwriting requirements, such as, this customer's employed, so needs pay slips, this one's self-employed, so needs accounts, etc. But nearly every lender in the space has a DIP that can be accessed at point of sale. And then also there is a number of lenders who have adopted facial recognition or biometric ID verification. So probably 2 or 3 lenders offer this, where you, via an app, which the customer can download onto their smartphone, they simply take a photo of their driver's license or passport, take a short selfie video, and through the wonder of technology, that will validate their ID and their ID documentation. Now, what all of those things added together give you is speed. And I would hazard that the average second charge, especially with no need for solicitors to be involved, would complete somewhere in the kind of 12 to 14 days from the point that you've given your advice. So a much, much quicker process than maybe you would see in the first charge space. Very broad range of second charge products available, as I said. Some lenders do offer some higher LTV products. So in the main, it's up to 85%. There are some lenders that will go above that, but there is going to be a more sizable margin in terms of the interest rate for that. But those options are there should you need them. And then another usage myth, if I put my teeth in, I'd like to just cover is that second charges are only used for debt consolidation. And again, that's not the case. the purpose of a second charge is quite varied. So yes, debt consolidation does appear in 60% or so of cases, but typically it's alongside another purpose. Our most common purpose at UTB is home improvements with an element of debt consol. So normally about 40,000 of home improvements and about 10 of debt consolidation. But certainly not debt con only. And not just for debt consolidation, of course. So I mentioned before, home improvements. People in COVID have been sat working at home, really want to put that extension on now, or want to do their garden up, or want to put the new bathroom in. That's available. We have done second charges for a wide range of purposes, including speedboats and school fees. But really, any legal purpose tends to be available. In terms of the typical customer profile, this is what surprises many people at times. Actually. Most lenders offer for 18 to 85 UTB. Our average is mid-40s. 3 out of 4 of our applicants are married, normally with 2 kids. Normally those kids are age 9. They earn between 60 and 70,000 pounds per house in the household, which is just a bit more. It's about 15% more than the national average. Pretty even mix in terms of their income types. About 70% employed. About a quarter employed and 5% maybe retired. The closer you get to retirement, the more important it will become on proven post-retirement income. Typical property value is a 4-bed, semi-detached at 350k. Now, interestingly, that's about 100 grand more than the national average property price, which again leans into the fact that second charges are very much more a prime product than they used to be. And in terms of the market composition, around 80% of business is prime. So that's people with no adverse, could have walked into the high street to get a remortgage, but didn't because it was too good to touch. About 15% near prime, and about 5% have some sort of subprime, and that is quite a small market sector, but it is still there. So from my perspective, I certainly couldn't agree with people that say they don't see second charges in their business. And actually, some of these stats here on this second page really go to support that prime profile. So average borrower, 65% LTV, although options are available higher. Typical value, and these are based on the Finance and Leasing Association's numbers. It's about 50 grand average loan size, taken out over 14 years, although they, as I said, redeem with typically in year 5. Just over half of people take a fixed rate. Typical fees are around 4% we see at UTB for the broker to charge. Now that will include valuation, that will include any referencing, etc. And most importantly, for me, I think in terms of conduct outcomes, the arrears and repossession rates are basically the same from second charges to first charges. So if this was a product that wasn't catering to customer needs or giving a positive customer outcome, you would see a far higher percentage there, somewhere in the realm of 0.07% versus 0.1%, which is first versus second. So very, very, very comparable. Got a couple of case studies here, which I'll just touch on, just to kind of bring to light some of the options that are available now. Case study 1 here is 48 grand loan at 85%, looking to purchase shares in a company that the individual actually worked for. Now, we did this loan. We simply insisted on the customer seeking investment advice, but they did benefit from an AVM. The case was offered 5 days after we received it and completed 4 days after that. Second example here is 175 grand loan for a buy-to-let investment. We've been seeing quite a lot of these actually recently, customers looking to raise finance on their main residence to plough into buy-to-let. The security was actually an ex-farm and the surrounding land, and there was 2 buy-to-lets on that same title. Now, we checked to make sure there was no agricultural restrictions in place, but we're able to proceed and completed that under our standard criteria. That wasn't an exception. Seconds can suit, as I said, many customers, and there's a choice of routes to access there. So yes, some lenders do offer applications direct, but obviously going through a specialist distributor such as Brightstar, you will benefit from their expertise, their on-site underwriters, often exclusive rates available as well, and typically either advice or non-advice is available. So just to finish off, and I'm nearly bang on my 20 minutes here, the second charge is great product for your customer toolkit. many lender and product options available, and absolutely should be a part of a best advice framework. And most importantly, it's not the market it once was. Thank you very much, everybody. I appreciate your time, and I hope you enjoy the rest of the day. Thank you very much.